Hello and a warm welcome to you on another edition of Business Africa. I am Afolake Oyinloye. Coming up, unrevised mandate of African central banks, a threat to financial strength and stability. Champagne consumption in Gabon impacting the economy. And Mozambique's rail sector sees major boost as passengers outstrip available trains. Financial strength and stability gives a nation the ability to focus and solve other issues. But for many African nations, financial strength seems to be a very tall dream. In many ways, financial strength and stability has eluded these African nations for so long. Experts say this is partly due to unrevised mandate of the African central banks. Cedric Mbeng is a finance expert and is also the author of the book Financer l'Afrique. He will be joining us after this report.
Even though growth has remained consistent, the financial strength and stability meant to follow up such growth has been lacking on the continent. In many opinions, this is as a result of the unrevised mandates of the African central banks, aside many other factors like the underdevelopment of financial sectors in Africa. Assets in most low-income African countries are smaller than those held by a single medium-sized bank in an industrial country. The absence of deep, efficient financial markets affects policymaking, hinders poverty alleviation, and constrains growth. In addition, many of the African central banks still hold on to mandates that are as obsolete as colonialism, and the need to revise these mandates is pressing. At the inception of any structured central bank, there is a stipulated mandate that guides the activities of the bank. The mandate of the Central Bank of Nigeria, CBN, for example, is derived from the 1958 Act of Parliament as amended up till 2007. The CBN Act of 2007 of the Federal Republic of Nigeria charges the bank with overall control and administration of the monetary and financial sector policies of the federal government. The Bank of Ghana is charged with formulating and implementing monetary policy to achieve price stability, contribute to the promotion and maintenance of financial stability, and ensure a sound payment system. These individual mandates could benefit from a revising of the original mandates to accommodate newer economic realities.
Cedric Mbeng recently launched a book, Financer l'Afrique, with focus on strengthening local financial system. The author joins us now from Abidjan, Côte d'Ivoire, to share more insight on the issue. Welcome to the program.
Thank you. Right.
Your book makes reference to the mandate of African central banks, explaining the overarching need to revise the mandate of African central banks. Let's hear more about it.
In reality, I think that the central banks, like other institutions, have functions and attributions that do not develop ex nihilo. They are deeply influenced by the development of ideas, theories, and perceptions about their role in society. And this is why I think that the central banks in today's developed countries is the result of the past transformation of these countries. And central banks' mission must be in line with the local realities of the economy. In developing countries, inflation targeting, like now, should not be the main mandate of the central bank. And the central bank must be a partner in finding solutions on issues related to credit, long-term financing, financial inclusion, and even infrastructure financing. Yeah, the financial stability is the key, but in addition to financial stability, they should also focus on growth. They should also sit down with the government to speak about how to fund better the economy, how to make available long-term funding in the economy.
Having written extensively on the topic of finance, what do you think is crucial to the financial success of any country, irrespective of location or people?
Yeah, precisely. When you look at the history of all the industrialized countries, for several countries, it appears that no country has changed without deepening its financial system. The priority is to build formal savings in the different parts of the economy, especially through the banking system, the pension fund, insurance company, and other financial institutions. then mobilize this saving to finance the real economy on different maturity, from short-term to long-term. This requires a clear organization and a credible incentive to different stakeholders in the financial ecosystem. If you look now the situation in Africa, the average saving rate is below 20% in terms of GDP. This is very low. The average credit to private sector is around 28% in GDP terms. This is really low. Only less than 4 adults in Africa are banked. And this is some challenges that we need to deal with.
Based on current statistics, can the average failing African economy survive the next 5 years economically without intervention or aid?
The real GDP growth in Africa was estimated at 3.6% last year, compared to 2.2% in 2016. 18 countries last year grew more than 5%, and 37 countries grew around 3%. And even if you read the last edition of LSDB, African Economic Outlook, the forecast for this year is 4.1%, and next year is the same, 4.1%. I don't see failing economies, but there are some challenges, and we need to deal with the challenges. And the main message of my book is that Africa is a net creditor of the rest of the world. It exports more capital than it receives. If only we look at the illicit financial flow, they represent 4 times our national debt. This is why the priority must be to intensify its local financial system to mobilize capital needed for its transformation. To answer to your question, African countries do not need free money. They need more investment.
Well, thank you very much for those insights. We're taking a break, and when we come back, we'll take a trip to Libreville, where champagne business is on the high. Stay with us for the party.